All right, now on to chapter 2, why I trade Forex. So I know a lot of you will be like, I want to trade Forex because I need money, right? But these are three reasons I think everyone should want to trade Forex. So we have liquidity, leverage, trends, right? Now, what is liquidity, right? This is more than just how large the market is, but how actively the market is being traded. The Bank of International Settlements, this was way back in 2013, conducted a survey where they were looking at trade volume in trading Forex as well as other derivative markets, right? So on a daily basis, right, on average, there was approximately $5.1 trillion worth of notional value being traded in the Forex market. Right. So now let's compare that to the stocks market, which is a little more than $212 billion on an average, right? So how is this translated to benefiting individual traders, right? So now we know liquidity Forex has a lot. It's a lot liquid more than the stocks. Now, how is that beneficial to us individual traders? Now, a more liquid market tends to have, number one, lower cost, right? A trader in a more liquid market like this is potentially going to have lower costs coming in two forms. Lower spreads, which we will explain, commissions, right? Now, with Forex, traders are charged no or low commissions on trades, right? So let's say in the stocks market, I want to buy a stock, right? The fees I'll be charged could be about $20, $50 just for buying a stock, right? Just for investing in a stock. Compared to the Forex market, I could be charged $1, right? $5, because this is an advantage of a more liquid market, right? Second reason why we want to be trading in a more liquid market is 24/5 access, right? The market trends 24 hours each working day. Compare that to the stocks market. Stocks market opens during, let's say, its session, New York session, right? Closure around 8, and that's it. Now, third reason is an instant execution. When a trader buys or sells, the action is sent to his broker to execute the order on the trader system at the price at which the trader has sent his request, right? So immediately you tap on buy, that instant you have your order executed. Immediately you tap on sell, that instant you have your order executed. Now, our second reason is leverage, right? Leverage means an investor is able to control a very large position with a small amount of margin, right? So you have this graph here, just someone having a little money, put it on this weighing scale, and you can see even with his little money, he's able to overweigh this huge sums of money. Now, leverage is expressed as a ratio. This 1 is to a number, represent the number by X. Right now, let's take an example of a leverage. Let's take a leverage of 1 is to 1,000. What this means is that a trader holding $100 margin in his account is able to control $100,000 worth of notional value. Now, how do we know this? We put 100 is to 100,000. Cross out the zeros. What are you left with? 1 is to 1,000. Now, this notional value is granted to you by your broker, right? So now my first question with this example. So with $10, how much is a trader able to control using the same 1 is to 1,000 leverage? Comment your answers and let's see who actually gets it right. Now, advantage of leverage. It takes a small price move for a trader to take advantage of their trading opportunity. Because of the use of leverage, a small price move in the market makes traders gain big profits, Why is that? Because 1 is not equal to 1, but 1,000, right? Note, this can also work against you in the case of a losing trade. Now, our third reason why trade Forex is that the Forex market is likely to go up or down, right? Same thing for every company stock. It can actually go up or down. Now, advantage of Forex is that if it's going up, I can actually make money. If it's going down, I can also make money, right? This is the third advantage why you actually want to trade the Forex market. All right, on to the next chapter. Hope this actually helped. All right, margin and leverage. Now, in order for a trader to open and maintain a position, the trader must deposit with a broker. Now, what does the broker do? They take a portion of your account balance, a portion of the deposits you've made, and they keep it in order to cover for any losses you incur, or to keep it so you actually can have your trades, running. Now, margin and leverage work hand in hand. Now, remember in chapter 1, we said Forex was for the big guys. So if you wanted to buy one standard lot of Euro USD, I think the next chapter, you actually understand standard lots. You actually know currencies, right? You actually need $100,000 in your account to actually open this position. But now with a margin requirement of just 0.1%, a trader needs just $100 to buy, providing their leverage for the trade is 1 is 2,000, right? Now, all these calculations, we are just doing it so you actually understand how it works. But on the long run, your trading journey, you wouldn't really need it. So calculation 1 divided by 1,000 times 100,000 is equal to $100, right? If the leverage is changed, then the margin requirement also changes. Now, leverage is equal to 1 divided by margin requirement. So let's take margin to be 2%. How do we know the leverage? 1 divided by 2%, which is equal to 50. And remember, leverage is expressed as a ratio, so that should be 1 is to 50. All right, now, as I said, these calculations, just for you to actually understand what we are doing better, you wouldn't actually be calculating this on your trading journey. So just have an understanding on it and you are good to go. Now let's look at these terms. Equity. Equity refers to your trading account balance. So let's say you deposit $100. That is your trade account balance, right? Plus or minus your profits, plus your profit or loss from open positions is your equity. So now you look at the image at the far right, you have balance to be 190,493. Equity is 455,797. So now we have positions, Euro USD, the first one giving us 251,500. The second one, 13,804. Now, equity is your balance plus open positions. So if you actually add up the balance plus these open positions, you should be able to get the equity figure. Now, a quick example, drop your answers in the comments, right? I deposit $250. I open a position and it's currently running at $25. What is my equity? All right. Now, free margin, this is the formula for free margin. As I said, this, you wouldn't need these calculations much, but if you are that curious, you see balance, you see equity, you see free margin, you want to know how it came about free margin, this is actually the formula. Now, margin call is actually not a good thing, right? Now, you receive margin call from your broker if you don't have enough equity to trade. If you are losing money, you are close to losing all your money, you receive a margin call. So margin call is not actually a good thing, right? Now the leverage and the margin requirements, this is just a brief of it, right? So me trading with $200 using a leverage of 1:50, I'm trading as though I have $10,000, right? Remember, in the past, Forex was for the big guys. Now, what did brokers do? They introduced leverage. They introduced leverage. So I'm trading as though I have a big account with the use of leverage. All right. Okay. Thank you for your time. On to the next chapter. Hello, guys. Today we are going to look at pips, lots, orders, and spreads, as well as currency pairs as well. All right, so let's begin with spread. So spread is the difference between the bid price and the ask price for currencies. Now, what's a bid price or an ask price? I believe you have been to a Forex bureau before, right? You want to change dollars to euro, you see buy at this rate, you see the sell at that rate. All right. The bid refers to the price at which you can sell the base currency. The ask refers to the price at which you can buy the base currency. So let's say I have euro, I want to change it to dollars, and they put buy euro at 1.5, sell at 1.2. So now that difference between the 1.5 and the 1.2 is called the spread. So 1.5 minus 1.2 should be 0.3. So that difference between the bid and the ask is the spread. So now here it says the bid refers to the price at which you can sell the base currency. The ask refers to the price at which you can buy. All right, so bid is sell, ask is buy. Now the spread is measured in pips. Now we are talking in Forex terms. Now I did say base currency. What's base currency? We have base currency and core currency. The base currency is the first listed currency pair, and the second is the quote currency. All right, so now, Forex, we are trading one currency against the other. There are other things like commodities, gold, silver. There are stocks index, which is NASDAQ, US 30, right? There are a whole lot, right? But the most popular is the currency pairs. We are trading one currency against the other. Now, here you have AUD slash USD. AUD is the base currency, right? Like we said here, the first listed currency pair is the base, and the second is the quote currency. All right, so keep in mind. Now, from the left up, GBP slash USD is equal to 1.21228. The GBP is the base currency, right? USD is the quote currency. Now, if you see GBP slash USD is equal to 1.21228, what does it mean? Let's say we have an imaginary one in front of the GBP. This means £1 is equivalent to $1.21228. So if I have £1, I want to change it to $2, I'll get $1.21228, right? So this is how you read this then. All right. So here, base quotes, the bid price, the ask price, right? Now let's see how we can actually calculate for spread. So here, follow the cursor. We have USD slash JPY. The bid is 118.16. The ask is 118.19. So the difference between 118.16 and then 118.19 is 3, right? Perfect. So now you know how to calculate for spread. Difference between the bid and the ask. Now we move. Spread is equal to ask minus bid. Now we have Euro USD. 1.1245, and the ask is 1.1246. So can you guess what the spread is? 1. Exactly. So you can actually calculate for the spread for the rest of this USD JPY, and then you send the answers to the comment section. All right. Now we move on to what are Forex currency pairs, right? A currency pair is a quotation of two different currency. So from the name currency pair, right, we are pairing two currencies. So euro, you have dollar, right? That's a currency pair. Now the three letters currency symbol that represents every currency was set by the International Organization for Standardization. So they represented the US dollar with the code USD. So the first two letters represents the country, and the third letter represents their currency. So US, United States, which currency do they use? Dollar. All right, so then USD. Now there are three kinds of currency pairs. We have the major pairs. Major pairs means it's actively traded every day. It's actively traded. Minor pairs, not that active. Exotic pairs, they are not really traded much, right? Now, major currency pairs are classified major because they are the most popularly traded ones on a daily basis, right? The euro against the US dollar is the most liquid currency pair because of how mostly it's being traded, all right? Currencies that trade the most volume against the US dollar are referred to as the major currencies. So take note, currencies that trade the most volume against the US dollar are referred to as major currency. All right. So we have the euro versus US dollar. We have the Great British Pound versus US dollar versus Japanese yen, US dollar versus Swiss franc, US dollar versus Canadian dollar, Australian dollar versus US dollar, New Zealand dollar versus US dollar. So take notes, these are the major currency pairs. They are just about 7, I believe. 1, 2, 3, 4, 5, 6, 7. Yes. Euro, pound, JPY, Swiss franc, all right. So these are the symbols. So anytime you see EUR/USD, you should be able to tell this is Euro USD, GBP/USD, Great British Pound, US dollar. All right. We move to the minor currency pairs. Minor currency pairs involve some major pairs which do not include the US dollar. All right. They're also known as cross currency pairs. So take note, minor currency pairs involve some major pairs which do not include the US dollar. Let's go back to the major currencies. This was euro versus US dollar. Minor pairs, we'll take the euro, let's take pound, Japanese yen, Swiss franc, Canadian dollar, Australian dollar, New Zealand dollar, and cross them. That's the minor currency pair. So you have euro versus Great British Pound, euro versus Japanese yen, pound versus yen, Swiss franc versus Japanese yen, pound versus Canadian dollar, euro versus Australian dollar, New Zealand dollar versus Japanese yen. So you can see these are cross currency pairs, right? Excluding the US dollar. Now, exotic pairs include a major currency pair and currency of a developing economy. These aren't often traded, making the spreads very high, right? Spread is more or less the amount you pay to have your trade executed. It's actually instant. So the higher the spread, the higher charges, right? Now, exotic pairs, because they are not mostly traded, it has a high spread. So just take a major currency pair versus a developing economy. Which country are you in? So US dollar slash your currency, the country you are, the currency you use, that falls under exotic currency pairs. And these are not mostly traded, so it has a huge spread. Now, what is a pip? I'll take this. Pip is a general knowledge for all traders. All right, so pay close attention to pip. Percentage in points. Well, you wouldn't need this full meaning as time goes on. This is a required knowledge for all traders, so please pay attention. The pip expresses the change in value between currencies, right? So let's take US dollar versus a developing economy, GHS, Ghana cedis as our currency pair. Now let's take the quote price to be 5.7824. If after some time this figure increases to 5.7825 or decreases to 5.7823, there is a 0.0001 change in value. That change is 1 pip. All right. Now, generally, a pip is the fourth decimal place in every price quotation. So the fourth decimal place is where we start calculating for pips, with the exception of any currency pair with JPY as quotes that has pip at the second decimal place. All right, so first example is Euro USD, which is equal to 1.1907 with a 1 on top. Now the exponent 1 on top is called a pipette. All right, so now how do we determine pips? All right, so first example, Euro USD is equal to 1.11426. We had our new quote price to be 1.11403. All right, remember pipettes is the fifth decimal, and that represents it as a point. So we start calculating pips from the fourth number after the decimal. So new quote price pips is 2.3 pips. How do we get that? 42 minus 40. So we have 1.114 here to 1.114. So the change didn't occur there. The change occurred at 26 and then 03. 6 minus 3 is 3. 2 minus 0 is 2. So 2.3 pips. Remember, the fifth decimal is a pipette. Represent that with a point. So that change in the fifth decimal is point, the change. All right, so this is 2.3 pips. Now we look at that for the JPY, which was 113.512. The new quote price is 113.411. So remember, JPY pips calculated from the second decimal. All right, the second number after the decimal. So the third number is a pipette. So you present that with a point. So the change 113 is the same here, 113 the same here. The change 5 and 4, which is 1. 1 minus 1, which is 0, that's 10. And the pipette 2 minus 1, which is 1, giving us 10.1 pips. All right, so can you calculate the pips for these, odd USD and then Euro USD? Great, so you can actually comment your answer and I'll rectify and let's see how it goes. All right. So pips aren't just numbers, take notes. They have values. To know these values, you need to first know lots. So I told you we'll get back to lots. Now, what is a lot in Forex? Take note, this is a required knowledge for all traders, right? Lot is the measurement of currency units used to determine how many currency units are required for a trade. All right, let's go to kinds of lots. We have standard lots, we have mini lots, and we have micro lots. All right. Now, what are the values for these? All right, so previously we said the pip expresses the change in value between currencies. And to know these values, a trader needs to know about lots. So now let's go with the first one, standard lots. The volume is 1.00. So to have a standard lot, you start from 1.00. When you begin trading, we show you the MetaTrader, you actually understand this better. Now, the value per pip on a standard lot is $10 per pip. Now, mini lots start from 0.1. The value for it is $1 per pip. And then micro starts from 0.01. The value is 10 cents. All right. We come back to this example. Here we had 10.1 pips. All right. Let's say we were trading with one standard lot. The value of one pip for a standard lot is $10. So 10.1 pips will be equivalent to how much? $101. If you had that, you got it right. So this for a mini lot is $10.1. This on a micro lot is $1.01. All right, so now this is how we know the value for pips. So you can actually calculate pips for this. All right. And then you comment it below. I'll let you know if you had it or not. Now, Forex other types. We have 3 other types: market order, limit order, and stop order. Right, market order, you go to the market, you want to buy Euro USD. At that very price, right, you just tap on buy and instantly you are in a trade. You tap on sell, instantly you are in a trade. But how about when you actually want to wait for price to reach a certain point before you actually trade it? That is when you use the limit order or the stop order. All right, this is actually self-explanatory. Let's take a look at take profit and stop loss. These orders are used to manage open positions. So let's say I have a trade opened and I need to leave the charts. What do? I set a take profit. Now, this is a command I'm giving the broker. This trade I'm in, if I should make $10, automatically close my trade for me. All right, then you set the take profits there. Now, if this trade goes against me, I don't want to lose more than $5. So if I lose $5, automatically close this trade for me. That is the take profit and stop loss order. Now let's look at limit orders. Limit order, you buy at a limit price if the currency market price falls to that level. All right. So I want to buy gold at 2,000. Right now, gold is at 2,050. So what do I tell the broker? I set a limit order. If gold should drop to 2,000, buy for me. All right. So in this situation, you are not in a trade until gold actually falls. All right. Same thing for the sell. So sell above the current price. Gold is at 2,050. I only want to sell gold if gold should reach 2,070. All right. So above the current market price, then you set it. All right. Read on stop order. Let me know if you actually understand it. Comment your explanation. All right. I hope this actually helped you. On to the next chapter.